Good afternoon, everyone. Welcome to this afternoon's webinar, Financial Stability Analysis and Data, Minding the Gaps, a conversation between Randy Quarles and Daryl Duffy. My name is Trish Mosser. I'm the Director of a Program in Central Banking and Financial Policy at Columbia University's School of International and Public Affairs. And it's my pleasure to be the moderator today, as well as a member of the organizing committee for the event. In fact, today's event is the first in a series of webinars on this topic. And that series will be hosted and is sponsored by the Center for Financial Policy at the Smith School of Business at the University of Maryland. And I want to thank the Smith School, particularly Russ Wormers, Professor of Finance at Maryland and head of the center, for making today's events and this webinar series possible. The Center on Financial Policy regularly brings together leaders from the regulatory, academic, and financial industry to discuss policy issues, and today's a great example of that. Today's conversation is going to focus on the high-level needs to better monitor and measure financial stability risks, the needs of policymakers, of regulators, financial practitioners. And that includes gaps, including those left perhaps unfinished from the last financial crisis or from Dodd-Frank passage 10 years ago, as well as new lessons and needs, if you like, things that we have learned in the past 6 months from the current crisis. As I mentioned earlier, this afternoon's discussion is a kickoff for a series of expert webinars, which will explore in more depth the key areas where we can do better. Data needs and gaps, standards and confidentiality and sharing, governance, and infrastructure. Our two speakers really don't need introductions, but here goes anyway. Randall Quarles is the Vice Chair for Supervision at the Federal Reserve Board of Governors and the Chair of the Financial Stability Board, the international coordinating body for monitoring and measuring financial systemic risk and for coordination across countries to strengthen the global financial system. Joining him is Daryl Duffy, Adams Distinguished Professor of Management and Professor of Finance at Stanford University's Graduate School of Business. He's written widely on the places where financial systemic risk is high, where we don't know enough, and where improvements can be made. In addition to the conversation, we will welcome questions toward the end of the webinar in the second half. If you have questions, please feel free to write them into the chat, and I will try to pull them together and present them to the panelists as we go. And without further ado, Daryl, the floor is yours.
Oh, thanks so much, Trish. And first of all, let me give you personal thanks for hosting and organizing and moderating today, and also thank you, Professor Wormers, for inviting me to participate in this really interesting conversation with Vice Chair Quarles. I have a few gaps that I want to talk about, but actually I think it might be a good chance here to ask Vice Chair Quarles, would you give us an idea of what this initiative at the Financial Stability Board, which you chair, is all about? What are your objectives, and how is it coming along on data gaps?
Certainly. So, and some of this will be familiar to many of the folks who have logged on. But so after the 2008 financial crisis, the G20, the finance ministers and central bank governors of the G20, asked the FSB and the IMF to look at information gaps and make recommendations for what improved data collections there could be. And that resulted in the issuance of a joint report in 2009 between the FSB and the IMF on the financial crisis and information gaps. And that set out a series of recommendations. And after we issued the report, then the G20 endorsed a plan by the FSB and the IMF to monitor implementation of the recommendations that were in the report. And we called that the Data Gap Initiative. It's gone through a couple of phases. This is now, it's now in the 5th year of the second phase. I won't bore you with the bureaucraties of what's involved in the definition of the phases and so forth, although it was all heavily negotiated and very important. But The second phase essentially aims to implement the regular collection and dissemination of more reliable and timely statistics for policy use, and in particular, looking at monitoring risk in the financial sector, looking at data on interconnections, data on spillovers, which didn't exist before, and then methods for data sharing among relevant financial authorities and communication of the official statistics. So that project has been going on for 5 years. The objective was to have it done, have that completed relatively quickly. COVID has set that back a bit, and so we've moved all the deadlines for many things, including this, back by about 6 months. But that means that our objective is to have completed this implementation of improved gathering and dissemination of data by the end of 2021, by December of 2021.
Oh, that's really helpful. Well, as I said, I have a little laundry list of data gaps, so maybe we could talk a bit about that.
Sure.
I agree with Trish that tremendous strides have been made since the financial crisis, and with MiFID II and the Dodd-Frank Act, we have much better data repositories in most respects. But of course, if we're looking forward to gaps, the first thing that comes to mind, especially someone like me that studies financial markets, is the March episode in the Treasury markets, where we had quite a lot of dysfunction, and academics and regulators and market practitioners are trying to suss out, what happened. And when we do that, I've come across some annoying data gaps, and one of the areas, you're not personally responsible, the Fed is not personally responsible for the Trace FINRA data set, but that's one area that's coming along, but it's going pretty slowly in terms of what we're actually getting to see. So I wanted to first say one or two things about where I see the gaps are there, and maybe you'll have a reaction, or maybe you'll want to go into a different area entirely, because I know, as you said, connections are important and so on. So where I see the gaps in the Trace data set, well, they're in two areas. Number one, the public doesn't really get to see the data yet, except in a few broad aggregates, so it's not much help to market practitioners and academics. We heard in this morning's Treasury Market conference, Matt Andreessen, who's an asset manager, spoke about opaqueness in the Treasury Repo market, and I see opportunities there for a lot more forensic analysis of what happened in March if we had access at the public level. But even as I understand it, even the official sector still doesn't have detailed time-stamped information that would allow it to match futures treasuries, cash treasury trades, and repo trades to see what trading patterns might be causing unusually high demands for liquidity, for example, because the LEIs are just not tagged into the data sets sufficiently. So, I could go on a bit. I mean, these data are exceptionally important. Even in Europe, they have some treasuries transactions data under MiFID II. It's just kind of ironic that they can see the data there and we can't here. Any thoughts on this topic?
A few. So I guess it depends on. So on the availability of data to the official sector with respect to treasuries and Treasury Repo. So obviously, and this will be obvious to you, but may not be obvious to everyone that's listening. It depends on it depends on the type of repo. So the so-called tri-party repo is settled on the Bank of New York Mellon platform. We have pretty good visibility into through our supervision of Bank of New York Mellon. We have transactions level. The official sector, have transactions level data that's reasonably complete. Bilateral repo whether it's brokered or through direct transactions, we have less visibility into. We don't have no visibility into that, again, through supervision of one side or another of a number of the transactions. And obviously, and again, this will be familiar to many people listening, but not to everyone. One of the reasons that's important is one of the potential narratives around what was happening in March and April was sort of forced selling by deleveraging hedge funds of their positions in highly leveraged Treasury trades. Basically, they would buy Treasury futures contracts and at the same time buy the Treasuries that would be sold into those contracts and finance the Treasuries, heavily leverage the financing of those Treasuries. And with the movements and volatility in the market in March, they needed to unwind those positions, and that was could have been a reason for a significant source of selling.
Just to make sure I get the story on that, are you talking about the cash futures basis trades or more of the longer-term risk parity type?
No.
Positions?
With respect to this narrative, it's principally cash basis, the cash futures basis trades. So that narrative is out there, and we don't have in the official sector, sort of granular data on hedge fund holdings and transactions in Treasuries. We have, again, some ability to get a sense of that. I think our view is that that was not a significant source of the pressure that we were seeing in the Treasury market, but obviously we don't have the actual granular data to confirm that view. It seems as though there were other more significant sources of pressure in the Treasury market there.
By the way, I have had, just to interject, I've had these, dozens and dozens of emails over the last couple of months trying to sort out how much of selling pressure there was coming from cash futures basis unwinds, how much was coming from risk parity, how much was foreign official sector liquidations and others. And of course, very limited data with which to sort that all out. But it's really interesting, and it speaks not only to financial stability, of course. These data are important for market transparency, for market efficiency. When buy-side firms want to check the quality of their execution and they can't see what this CUSIP traded at in the last few minutes, it's not as good for market efficiency.
So I completely agree with that, and sort of the remarks that I was making at the beginning were about what it is that in the official sector we can see, what at the Fed we can see, and obviously there are limits to that, but almost none of this is visible to the private sector, whether it's tri-party transaction level data or certainly bilateral repo.
Well, I gave you the top item on my list. Maybe I I have some other items, but what about you? What's your focus right now on in terms of the most pressing needs for more data?
Well, I think you have. You've hit on what is for me as well close to the top of the list, which is the data necessary to unravel what was happening in the Treasury market in March and April. There are all those competing narratives. Again, many people logged in will know them, but some might not. I think our sense right now of where the pressures were coming from were. There was a certain element of pressure from the regulatory framework that limited the ability of some of the dealers to expand holdings given the dash for cash, and I don't know that was significant, but that's certainly out there. Sales by foreign central banks was a significant source. I think right now we would say that was a more significant source than the unwinding of leveraged hedge fund positions. But that is, that's not a additional data would improve that understanding. And then, of course, there are issues about just the overall size of the Treasury market relative to the private sector infrastructure to deal with it. I mean, the amount of Treasuries that are out there is much larger than it was even a few years ago, and certainly larger than it was a decade ago. And we don't yet know. This isn't necessarily something that additional data is critical to understanding, but perhaps it would be. We just, we don't yet know, particularly in periods of stress, whether the private sector infrastructure is just up to the task of handling a market that is, a number of times the size of what it was just a decade ago.
Yeah, I agree with that. I've been concerned about the same thing. I noticed in March there were $2.7 trillion of foreign sales in treasuries to U.S. residents. Now, I'm assuming a lot of that, well, some of it came out of the Cayman Islands. I suppose that's some of that is hedge fund, but also a lot of foreign officials. And it is kind of overwhelming dealer balance sheets in surge periods like that. And as you said, the amount of treasuries was very large. I looked at the Congressional Budget Office projections, and we're at around 21, 22 trillion. Now it's going to be 120 trillion in 30 years, from based on their calculations. And dealer balance sheets are not getting bigger. So more transparency and maybe better market infrastructure. I agree with you. Central counterparties, actually, that's something I've been pushing on as a possible thing to look at because they not only reduce settlement risk, and that adds financial safety, but they make more efficient use of balance sheet. And on our topic today, they improve transparency because you pretty much know if all the large players are centrally clearing, you pretty much know at the CCP who's got what. Would it be impertinent of me to switch to another area?
Of course not.
Okay, well, another thing I'm looking at is actually not that far away. It's SEC lending transparency.
If you had not, I was going to raise it as the next thing I was concerned about. So.
Yeah, Dodd-Frank Act was 2010, and there's one section of it that charged the SEC with putting out rules for data transparency in the SEC lending market. They were pretty specific in Congress. I just checked this morning to see on the SEC's website, and still that's one of the few remaining items that they have left to address with rules. And I think it's really important, both for financial stability reasons and, again, for market efficiency reasons. That market is so opaque, it's very hard to tell what's going at what price. I noticed even in Brazil, they have, better SEC lending data than the U.S. in terms of public reporting. And SEC lending is also a substitute for repo. And I know that at some points in time, dealers have substituted repo with SEC lending transactions to get financing. So if one really wants to get securities financing transaction data gaps covered, then it's pretty hard to avoid covering both.
Yeah, I mean, we have, obviously we have aggregate data on securities borrowing and lending by the large banks and dealers, which we gather at the Fed and disseminate, daily and weekly. But that is, but obviously in each of those cases, counterparty information is pretty limited, and that's what the objective of the SEC regulatory project is intending to get at. It's while it is extremely complicated, and at the FSB, we also have a project. I talked about the General Data Gap Project, which we call the DGI. We also have the Data Experts Group, the DEG, that's working on the securities financing transaction gap specifically, kind of a larger part of the FSB's work in the non-bank finance sector. That I expect will be, while that work is has been ongoing and will be continuing. I think it'll be ramped up as part of the ramping up of the FSB's attention to non-bank finance in general over the course of the next couple of years.
Yeah. Well, I don't want to be a complainer today. I want to come back to some of the improvements that I see. And one of them is corporate bond price transparency. I think that's been a big win for transparency in the U.S. corporate bond market. And I talk to asset managers all the time who are looking at trace data to check their execution quality and to nab bargains and improve market efficiency by supplying liquidity. And so that's a big plus. And I was really pleased when the proposal or a test proposal to reduce the amount of transparency for large trades was shelved recently. So I think that's a positive step, that we're going to keep corporate bond transparency.
Yeah, I would agree with that. And in general, I'm very much in favor of transparency in these issues, both in the data on which transparency in government action generally, which means transparency about the data on which we're taking action. I think that's critical to being transparent about what it is that we're doing.
Drawing again from the Treasury Market conference this morning, there were some positive comments from Deputy Secretary Mucinich about improvements in Treasury Data, and the SEC Commissioner Reitman talked about the ATS proposed rule that they put out at the SEC just recently, and I think that will improve transparency in the Treasury market as well through at electronic trade platforms. So there are green shoots coming up everywhere.
I don't know. Are there things that you think ought to be on the agenda that are not on the agenda? So there's the question of there are a number of projects that we're working on described at one level or another of specificity and at one level or another of completion. But is there something that you think isn't even on the agenda? Not that it's being pursued inefficiently, but doesn't seem to have gotten the appropriate level of attention?
Well, and Dodd-Frank Title VII was a big success in terms of swap market improvements in financial stability and transparency. One of the big improvements was more transparency through swap data repositories in the entire G20. And those swap data repositories have been improving over time. It might be an opportunity to do a retrospective or status report on, are those data sets easily accessible, and are they relatively complete and accurate? I know market participants are using them, but they're not using them as much as the corporate bond trace data. And I'm wondering, is it that they're hard to use? There are a few firms like Claris that publish reports on them, but I don't see much in the way of just everyday use by market practitioners of this data, like I do in the corporate bond market for trace.
Right. So I have to say, I don't know. We haven't gotten complaints, at least they haven't come to me, about the data being hard to use, that there are ways that the official sector ought to be sort of improving the accessibility or manipulability of the data.
Yeah, I think the formats are different in different jurisdictions, but I think market participants could probably get over that if specialty firms take advantage of this data. Trish, do you want to interject with anything? Do you have any interesting questions coming in?
Yeah, actually, there's a couple that are here, and they're really closely related to the topic that we were just talking about. Kind of esoteric, but they were related to one of my questions too, which is about making data more compatible, or data standards being the term of art. I guess my big picture question is, why has it been so hard to make progress on this? It's like one of those to-do items, and it isn't that people aren't trying, but as your derivatives example shows, and I think the history of the legal entity identifier shows, it's incredibly difficult to get consensus. So maybe, I guess that's really a question to start with for Randy, but I'd like your observations too.
Well, there are a variety of reasons. Some of them interesting, some of them, quite mundane and uninteresting, but eternal. There are concerns in each jurisdiction about how to protect, and they come from slightly different angles, but they're nonetheless, depending on the jurisdiction, but they are nonetheless important, about sort of protecting appropriate proprietary information while gathering data and particularly disseminating data among different official sector bodies. And each official sector body, of course, knows that it is pure in heart and honest in intent, but worries that even within their same jurisdiction, let alone going across country lines, that if information is too granular and too broadly shared, that it can be taken for the wrong purposes. So ensuring that you get the data that you need while being appropriately respectful of the proprietary information of private sector market participants is so that's a serious issue. It's a resolvable issue, but that's something that takes work and thought, et cetera, and time. Then some of these things are just at a very, they have as part of them, sharing the data in an appropriate way. There are technical aspects to them that are extremely detailed. They require someone to pay attention. Most of the people at the top of the process wanting these things to be done don't have the detailed technical knowledge to actually understand the detailed technical things that are being done. They won't pay, so you have to get someone to pay attention to it. That's usually someone far enough down in the food chain that the people at the top don't even know who they are. So again, these are mundane but eternal problems with getting a project like this move forward. And then, of course, another eternal problem is just turf, which is that the more data is shared, the more people might have an opinion on the data that would differ from the body that has historically been charged with having a view and empowered by access to the data that could be generated, or by their particular relationship to the market, that more people might understand more deeply if more data were shared. So all of these are, again, some really quite boring but important, like the technical difficulty, some really quite annoying but eternal, like bureaucratic turf, and some, interesting and, and legitimate, like protecting proprietary information, that all make this a much more difficult project than it ought to be, but still all of them resolvable, and as Daryl has said, progress being made.
So,
yeah.
Sorry.
I was just going to add, maybe it's too anecdotal, but I'm going to say it anyway. I think this issue of turf is a bit like the story of the Dead Sea Scrolls. I don't know if anyone is in the audience is familiar with the struggle by scholars to get access to the Dead Sea Scrolls. They were discovered in the early 20th century in a place in Jordan, and the research institute in Jordan that happened to be in the right place to have them wanted to study them, and they wanted their scholars to have first dibs on those data or Dead Sea Scrolls for decades. And we don't know how long that would have kept up, but there was a 1973 war between Israel and other states, and that part of Jordan became part of Israel, and then the Israeli institute that happened to be in charge, research institute that happened to be in charge of the Dead Sea Scrolls, they wanted to have another 3 or 4 decades of sole access to those Dead Sea Scrolls. And the story, this actually is kind of a James Bond story about how some of the scrolls got out, but that just, I mean, it's just, I think what Vice Chair Quarles is suggesting is that if you have the data, there's no really compelling reason that you must share it, then you tend to hang on to it a bit more than one might. Changing subjects a bit, I don't know, Vice Chair Quarles, if you can say anything about the nature of the more sensitive data that are kept at the data hub at the Bank for International Settlements and what those are used for, what's in there and what's it used for?
Yeah, I would say there's nothing particularly surprising about what's in there. They're used for, central bank macroeconomic analysis for the most part. There's a lot of, again, this mostly because of concerns about proprietary information and confidential supervisory information that is shared through that data hub. There are, a lot of restrictions on accessibility to the data, even within the BIS, to ensure that there's a willingness on the part of national jurisdictions. And some of the highest concern comes from the U.S., but from national jurisdictions to be relatively free in providing the data. So there's a lot of restrictions on accessibility to the data to ensure that the BIS itself has as comprehensive a set of data as it can.
Again, changing gears a bit, unless Trish has an important question. I thought I would.
I've got one in a couple of minutes, but go for the next.
So in the Dodd-Frank Act, there was an Office of Financial Research established, and there was some thought that it would collect a lot of data, and it has done quite a lot. But I think the sort of subtext is maybe not as much as it might have under other circumstances. And so, I don't know, on a scale of 0 to 10, I don't think it's a 10 or 9 in terms of its original promise, or at least those who wanted to have it, its objectives. I don't know, maybe there was a just disagreement on whether it was a good idea in the first place between the two parties in Congress. I'm a Canadian, I'm totally neutral. Is the Office of Financial Research going to continue, at a reasonable pace to collect data and put it out? And if not, is its promise going to remain relatively less fulfilled than we might have hoped?
So I would say I actually so I haven't had a conversation with them about the data collection efforts as opposed to the research that they do, which I think is quite valuable and not and I think there's bipartisan agreement that the research is quite valuable. So I don't actually know what their plans are for data collection. I would say that staying away then perhaps from that specific question, but on a general framework of data collection for such uses, I think it's incumbent on us in the official sector to try to ensure that we're as efficient as possible in gathering the data. So I could see a framework evolve where if there are data that that they need or want, that perhaps the collection, they could work with existing agencies that have data collection efforts to, add a little bit to a particular form, or and the right agency that already has a lot of the information coming in, maybe a slight reorganization of it, or a particular sharing of information that might not currently be being shared even within the U.S. government, could answer that question, as opposed to being too quick for a separate agency to say, here's stuff that we would like to know, so let's just make up our own form and send it out. And now, someone has to, respond to that form when there are other data collections that may be quite similar, but they aren't the same. So I do think it's incumbent on us to ensure that we get the data that we need, but they coordinate among all the related arms of the government to ensure that we do that in as efficient a way as possible.
Yeah, I'm cognizant of demands also on market participants, especially banks, with respect to the data they have to supply. And it's important that they supply it, but every time I ask an economist at the Fed, well, why don't you just get that data from the bank? They kind of roll their eyes and say, well, yeah, we'll get in line with the thousands of other data requests that we're imposing on the banks. And, we have to be reasonable. And we can't expect them to supply every last bit of data that we might find useful.
The banks don't always believe that of the Fed economists, but in my interaction with them, I have found them to be quite sensitive to there's a lot of things that they would like to know, but when we have the conversations about what's the cost benefit of this particular data collection, they're always willing to say, "Oh, we could pare this back," or so they're better about that than I think the banks think they are.
Yeah, being a bank to me is a pretty complicated thing.
That's actually a great intro to my next question, which is huge amount of attention to the systemic risk in banking, rightly so, after what happened 12 years ago. Lot stronger system that's borne up pretty well. And indeed, both the events in March, as well as I think probably many of us who follow financial stability issues closely, have been concerned about this for even longer, which is the question about the non-bank part of the financial system and systemic risk. They certainly got a lot less attention, with a few exceptions. I'll put Fannie and Freddie over just for a minute separately. But a lot of the other non-banks are substantially more opaque, substantially less regulated, or regulated in ways that are very, very different from the way the banks are regulated. Typically much less emphasis on their systemic importance and their potential contagion. But March was March, not just in the Treasury market, but in a lot of other markets. And the U.S. is a market-based finance system, let's be clear. So I'd be interested in both of your views about both what we need to know more about. So what's the systemic risk questions that are important to answer, and then maybe a little bit about data from the non-bank sector. I tend to think it's in three pieces, but correct me if you don't like this classification. One would be liquidity provision, and we learned a lot about liquidity and credit provision by the non-bank sector, not only in wholesale markets, but actually retail markets in the last 6 months. And of course, leverage and funding risks, but even in the less leveraged sector, the liquidity risks seem pretty notable. My personal view is I think it's in part related to the tremendous growth in securities markets, which has a commensurate growth in things like the mutual fund industry and investment management industry. And the size of the banking system sitting in the middle is really not changed that much. So you guys made that point earlier, but I'd be sort of interested in what do you think are the most important things? I know we only have a few months, but that kind of big picture things that you'd like to know more about systemic risks in the non-bank sector, and kind of where.
Do you want to start, Dale?
Well, I mean, I would go back to our conversation on the Treasury transactions data. If we really want to diagnose what happened in March, we really need the official sector, at least, to have identifiers for all large legal entity identifiers, LEIs, for all large market participants, and to have them all reporting or have them reported by their intermediary. The way it is now, I understand it, is that FINRA dealers are the only required market participants to report. So, for example, a bank that's not a FINRA dealer, that's internalizing to market participants or trading with another bank, that's not necessarily going to be included. We don't have anything that would allow us to connect repo transactions by LEI with cash transactions or with futures transactions with good timestamps. So disentangling this is going to be very difficult. We may have to, unfortunately, wait for another surge of demand for liquidity after this kind of information is collected to figure out who's demanding liquidity from whom. But Trish, I want to come back a little bit to the premise. I think this is really important for understanding what happened and the ability of the market to intermediate the demands for liquidity. But I would be concerned if the message coming out of this is we need to find a way to tamp down demands for liquidity by market participants, because I've heard that suggested, and I think what we really need to do is to focus on the robustness of the market structure rather than trying to figure out how to get non-banks to trade less or to demand and I'm not suggesting you pointed this out, but to
that's a bell that can't be unrung. Sorry.
I mean, when there's a dash for cash like we had in March, I don't think it's going to help people to say no, you're not able to demand more than X amount of liquidity at this point in time.
I certainly agree with that.
I guess so. I agree with all of that. I would add. I don't know if it's necessarily adding, but the emphasis that I would place, and that I think our focus going forward at the FSB is going to be, is on information around interconnectedness with respect to the non-bank sector. So, at the risk of sort of oversimplifying in a bit of a cartoonish way, in the kind of FSB G20 response to the financial crisis, there was a lot of work on the banking system, and there was less, I would say, robust work on the non-bank system, and in part because the participants, because the question was framed as an issue of sort of entity type level resilience. What rules need to be put in place that were like the rules that were put in place to ensure entity level resilience of the banks? And there was a lot of resistance to that from the non-banks for practical, but also conceptual reasons that's not really focused on what the issue was. I would say, as we have begun doing it, so at the FSB we're doing a holistic review of what happened in March, and that'll be being published in connection with the G20 meetings that are happening in October and November. And one of the things with respect to the non-bank sector that I would say that we learned from that is the emphasis on interconnectedness as the sort of real stability risk there, as opposed to entity level concerns. And it goes to Daryl's point about market structure. And so I think that we need to focus on that. There has been a lot more willingness in discussions at the FSB to have kind of fruitful and candid discussions with the question framed that way, as opposed to, as opposed to what this showed us is that we need to go back to the question of imposing a bank type regulation on the non-bank sector, but rather, okay, well, what did we learn about interconnectedness and how might the regulatory framework affect that? I think that's where most of the FSB's focus is going to be, again, over the next couple of years in the non-bank sector. More data around that is something that will definitely be a part of trying to respond to those issues.
Yeah, I could not agree more with what you just said, Vice Chair Quarles. I think, again, going back to Title VII of Dodd-Frank, one of the big successes there is the swap central counterparties and the swap data repositories. But the central counterparties themselves, they just cut through those chains of interconnectedness. It becomes a hub and spoke. And you can first of all, two trading market participants are not exposed to each other. So that cuts down on the interconnectedness problem. And you also see at the CCP what each market participant has. And you have tight, one-day visibility on their ability to meet their margin calls. There's nothing in the dark about their ability to meet their payments. And there's uniform transparency on margin requirements, both initial and variation margin requirements. So you get a lot of improvements on the interconnectedness dimension with central counterparties. The downside, of course, is now you're all focusing all of your eggs in one basket. Right. And one needs to make sure that those central counterparties are totally resilient, and it just ups the ante on the quality of transparency that regulators have into the CCPs.
I think it's the old Mark Twain quote, all your eggs in one basket and then watch that basket.
Yes.
Very fun.
So this, again, is a little bit reductive, but I think we're trying to bear in mind in the discussions at the FSB as well in the regulatory framework for non-banks going forward is that again, you could. I don't think it's wrong, although reductive, to state that part of what happened in the aftermath of the Great Financial Crisis was a significant increase in regulation aimed at promoting the resilience of the banking sector. Banks responded to those incentives to the incentives created in that framework by shedding certain activity, which moved then into other parts of the financial system, which has grown, particularly as a percentage matter globally in response, but grown in the United States as well, although we were always more of a market-based system than, say, Europe. And so you've got a financial sector now that is, is responding to the credit needs of the real economy through these two factors, but we've pushed some activities into another part of the economy. If our response is to say, now we're going to respond to concerns about stability in this sector of the economy with the same types of measures that we put on the banks, then we're really just saying, well, that just means we want a smaller financial sector, which will limit its ability to provide support to the real economy. And while there's a certain amount of willingness to trade off stability versus dynamism, I think you have to keep in mind that that is a trade-off if you want to impose restrictions in the same way, as opposed to it being entirely costless. But
yeah, I agree with that. And I think where it goes to the non-bank and less visible sector, the focus becomes more who's getting short-term funding, who's connected to whom. But it's harder to impose capital requirements, at least with the current legislative framework. And I'm not sure that it would be all that effective. I think the current structure is working from the viewpoint of financial stability much better. What we saw in March was, I think, a sign that the banks are very resilient. and the financial system is sound. The questions that were raised about the Treasury market are more about, well, there is some question about counterparty risk in the Treasury market, but I think it's more about, is the U.S. Treasury security going to continue to be the bulwark of the reserve currency status of the dollar and the safe haven for the globe and a source of great price discovery in times of stress. And I think that's really important too. So the banking system being sound is great, and there's still more to do.
Actually, could I ask a follow-up question, which is related to the topic you were just discussing? And the big picture question is, what's a new lesson that we've learned in the last 6 months? Something maybe that didn't really occur to those of us who follow financial stability issues and are focused very on leverage and a certain amount of liquidity and so forth. And one of the things that came to mind is related to the non-bank question. And Randy mentioned it a minute ago, the increased role of non-banks in both credit and liquidity provision and payments provision. Not so much to the big wholesale markets, although they're doing it there too, but to the retail markets. I mean, one of the most interesting things I observed this spring was that we didn't really understand how to get payments to people, bluntly, in some cases, who to lend to and who was borrowing from whom for small and medium-sized businesses. And of course, in this crisis, those things were first-order important. They're always important, but they were particularly first-order important. I'm just curious, that's a different kind of interconnectedness between the financial sector, banks and non-banks, and the real economy. Is that something that we should care more about and be thinking more about from a financial stability standpoint?
I think the short answer is that yes. I think, at this point, I don't know where that thinking leads in terms of, so what are concrete policy changes that you would make in light of that. But I do think that that's the sort of thing we should be thinking about. Absolutely.
Yeah, I was thinking about your comment about measuring interconnectedness, and I was assuming largely within the financial system, banks, non-banks, and so forth. But this would literally be, do you sort of understand how the real economy is connected to the rest of the financial system? Which is
right.
At a high level, we all think we understand it. I assume, or we hope we understand it, maybe. But we don't measure it very well, I don't think. And so that was really my question. Should we be measuring it? Trying to measure it.
In the payments area, information is kind of a two-edged sword. You want to have it, but you don't want to have it.
Yeah.
China has decided it wants to have a central bank digital currency, and it will now be able to monitor pretty much every transaction in China if it's widely adopted. My guess is, and I have no one at the Fed told me, but I doubt that the Fed really wants to have a database that has every transaction between two Americans. That would be operational risk, data security risk, and many other kinds of political risk, possibly, and would also potentially lead to difficulties on monetary policy independence, because if the Fed doesn't do a great job, then
right.
It will get managed by Congress in a way that could impinge on its monetary policy. So the footprint issue comes up in the payments area quite a bit. That said, I think FedNow is a fabulous project, and if the Fed can figure out how to handle payments with FedNow in a way that improves the efficiency of the U.S. payment system, that will be great.
So it's interesting because we got it exactly. Thank you, Daryl, because I now don't have to ask a question about central bank digital currency from one of the audience members who asked pretty much that same question. Part of the reason that I mentioned the financial and non-financial is almost as a sheer, in this particular crisis, simply as a crisis management tool, that information, at least within the official sector, would have been incredibly helpful, is my best guess, in trying to design how to address, how to build programs and address the unusual nature of the current crisis. Let me ask one other question. Again, a little bit of an esoteric topic, and that's on data sharing. Randy mentioned this earlier as the difficulties of data sharing. There are certainly massive improvements just from a sheer technology standpoint for ways to share confidential data and allow it to be used. First of all, what do you think of those, and do you think there could possibly have any traction, whether it's the Financial Stability Board or elsewhere?
No, I think that we are making progress. Not only getting traction, but making progress on international data sharing efforts. It's not easy for the reasons we talked about at the outset, but again, the events of March have sort of focused everyone's attention and given a renewed impetus to some tasks that, again, through a combination of mundaneness, despite their importance, and reform fatigue, had begun to flag indefinitely, and I think they're being picked back up with a renewed sense of purpose and urgency, and I expect to see progress along a lot of these measures over the next couple of years.
No other? No response, Carol, sorry.
I don't have any insights into that. I think Governor Quarles, Vice Chair Quarles is on top of that, and I'm not.
So we are just about out of time. Let me apologize to all of the participants who sent in questions that I either very, very imperfectly compiled their questions into a higher level question. There were lots of additional questions about liquidity risk and counterparty risk and PCP. So I'll apologize to people that we couldn't quite get to all of those. I want to thank the Vice Chair and also to thank Daryl for doing this afternoon and helping us kick this off. As you can see from the conversation, there's a lot of unfinished business here. I'll put my personal opinion out there on ways to both get the right kind of data, get it in a way that's efficient and cost effective, and figure out a way to share it, not to mention set some standards so we've got some comparability. The future webinars that the Smith School at Maryland and the organizing committee are putting together will tackle those topics in a fair amount of depth, one-on-one. And so we look forward to seeing many of you at those. And one more time, let me thank Randy Quarles, let me thank Bill Duffy, and everyone have a very good rest of the afternoon or day, wherever you are.
Thank you so much. Thank you, Vice Chair Quarles.
Great pleasure. Thank you.